My name is Sharon Michaels, and I was asked to interview Ivan Sachs about his business practice, his approach to investing, and the lessons that he's learned over the years that would be helpful to me and really any investor looking to invest in a public company. So Ivan, it's great to be here with you today.
It's good to be with you as well, Sharon.
Okay, so if you would please answer clearly and as simply as you can, because while I think of myself as a relatively smart person, sometimes I get lost a little with the terms and the jargon words, and I don't want to lose my train of thought here. I want to be with you. So first, how long have you been investing for clients in publicly traded companies, or as people like to refer to it as the stock market?
I would say about 26 years. So that's a little over 1 year over a century, a quarter of a century.
And in those 26 years, which is a nice amount of time, how has your thinking about investing evolved?
Significantly. Because when you think about it, when anyone gets into a profession, year one, day one, you might have a great deal of enthusiasm and energy, but in terms of experience, that has to be extremely limited. So that was my case. I was extremely excited about applying my love of people and my love of numbers and deciding to get into the brokerage business. And so that's what I went out, was just to go out and meet people. Now, in terms of knowing anything about investing in companies in a practical sense, I'd passed an exam and done, my degree was in finance and in accounting, but there was no real hard experience in terms of investing. So it took time. So I would say that on a scale from 1 to 10, how much I knew in terms of experience, in my first 5 years would be probably very low, 2, 3, 4. But in terms of enthusiasm and excitement, not being jaded, not being cynical, I'd have to give myself a 10 during that time.
But now, over those 26 years, you've got lots of wisdom.
Now I've got lots of wisdom, I think lots of experience, and hopefully I don't become jaded and cynical, because adding the combination of experience plus enthusiasm and experience, it's wonderful that. Yeah.
And how do you decide what to invest in, and what's your thought process before making an investment?
So nowadays, what you have to look for, you're basically betting on people. If you have the right people who are experienced, seasoned during all times of ups and downs, and at the same time who have a business model or an asset that is valuable, that attracts anyone to that kind of business. So for example, if I knew, I met management and they'd been previously very successful. It wasn't something that they had put on their resume, but it's something in which you could actually see these guys have been successful, they've built a company before, they've sold a company before, and they've done it a few times. That is probably a pretty decent track record to go by. Now, do they have the right asset? Do they have the right business model? That comes through in the numbers. So you look at the numbers, and then you speak to the management to find out what are the opportunities, what are the risks. And that takes time to develop. And sitting down in front of people, just like you sitting in front of me, is one of the better ways of getting to know people. But the best way of knowing people is experience during good and bad times.
So before you're investing in a company, you're doing a lot of research. You're
Yeah.
getting in there and finding out what their thought process is.
100%. So what I do in general, if I like the idea of the company, I'll buy a little of that company. Buying a little of anything keeps you interested, keeps you in the game. Now, there's no ways I'm buying a serious amount in that time. It's just a matter of seeing how the numbers work, how everything else works. And I'm a shareholder. If I'm a shareholder, I'll become interested in owning this business. Do I want to really own this business, or do I just want to have a little toehold and I'll decide to extract myself or to go big into it? So it takes time. And I do go and visit the companies wherever they are before I invest as well. I need to meet the management and see how the business is on the ground.
So when I looked online, I see that there are about 285,000 financial advisors in the US, and you're probably one of these. How and why would I want to work with you rather than the other 284,999? I mean, besides your great personality and your great sense of humor, what differentiates you?
I think it might be a little bit more difficult for you to have to sit down with 499,000, and that becomes a problem. Even though I'm making somewhat of a joke, the problem becomes is how do you know? You might have 249,999 other investment brokers, advisors to go and interview or to try and entertain them as possibilities. How do I know if there's more than that in number of companies? So the same way as you're looking at me in terms of should I be your investment advisor, my question has to also be, do I want this company to be the one that I'm going to be buying? So it's a good question. Every company is different. Every financial advisor is different. And different strokes for different folks. And I think there is an idea of rapport, trust, experience. All of those things, factors have to go into account. So why would you work with me? I don't believe everyone should be working with me. I've got a certain philosophy, style, a way of doing business that I think might be counter to how other people believe, think, or feel. Our business is an emotional business. When things go up and when things go down, people can get terribly excited if it goes up and terribly depressed if it goes down. Those excitement emotions that are up and down need to be managed. That is where I come into it. I'm helping my clients to manage those ups and downs. I'm holding their hand so that they're not going to be jumping off the roller coaster while it's moving. That's not a very good formula, both in investing and in practical terms.
So over these years, you've come to see what a successful investor-advisor relationship is. So by successful, I'm meaning that you're happy and satisfied, and also the investor's happy and satisfied. So can you describe what makes for that successful advisor-client relationship?
I would say trust is the most important, but trust in the way that there's a listening on both sides. So for example, if I were to explain to a client who may inquire, Ivan, I see that one of our companies is down in value. Can they listen that my explanation is a real explanation and not a rationalization? In other words, if I'm going to be explaining it to them, can they trust me that I'm not spinning a story in order to make up for the decline, but maybe I have a meritorious argument that it's actually beneficial that the share price of that company is down because we can acquire more. It's more valuable now than what it was before.
You've had some experiences, I think we all have, right, that maybe didn't work out so well. Can you tell me about a relationship with a client that didn't work out so well?
Yeah, there's a few that haven't worked out well, not many. My retention rate is very high, but I think as long as there is a lack of trust, where a person might say and inquire more than just the inquiry into a particular situation, I would say, like, I've had to move my business 2 or 3 times. Wow. Why is he moving 2 or 3 times? I've been married for over 30 years. I'm stable there. I've lived in my house for over 30 years. Why are you moving? So there was a particular reason why I was moving. I was with Wells Fargo, well-respected company. I was with TD Ameritrade. But both entities, both companies, both big corporations had a policy that they did not want me to invest my clients' money into companies regarded as penny stocks, low price securities. Is it rational, their thinking, or is it irrational? Is it just part of putting things in boxes without any thinking? I would absolutely say for sure. But Wells Fargo, TD Ameritrade, and all the larger companies are catering towards the middle ground. They're not catering towards excellence. They're just trying to be sure that they are going to be risk-free. No matter how much I would explain to them my particular positioning and all of that, they weren't interested in that. As long as companies were below $5 a share, they were persona non grata in their situations. And so I was not going to give up on a winning situation. So I had to find a home. So I had to change my home to the third time. Hopefully this is going to stick, which I believe it will. I'm with Interactive Brokers, and they accept my way of going about doing my business. And so a couple of clients were a little resistant. Oh, well, why are you moving? And when I tried to explain, some tried to understand, and some people didn't. But in general, I haven't lost many clients at all for performance or anything else like that. That might have been one reason. Another reason might just be where people's natures are such that you can't govern people's natures. People have certain characteristics about themselves. And if they're going to start say, yeah, I trust you, and I trust you, and I trust you, but, and why this, why that, my business doesn't become enjoyable. It doesn't add productive conversation at all. And sometimes it's good that people leave. So I love my clients. I believe my clients love me as well. But there are times where separation is better than remaining just for the sake of it.
So investors or buyers of a service, investors or buyers of any service have expectations for the service that they're paying for. So what expectations do or should your clients have when they're working with you?
I think clients should, with whoever they're dealing with, have low expectations. Low expectations means that you can always do better. But if you have high expectations and you don't meet that, you can always do worse. So you don't want to be to the lowest point, but on average, if you look at the average money manager throughout the world, and in the United States, they're doing probably about 5 to 7% each year. To give you an idea, if I were to do 7% each year, there's a rule called the rule of 72, which basically means that your money can double in 10 years. So if I'm going to be doing 7% each year for you, you could expect the investment money that you gave me, whether it was 10,000, could become 20,000, 100,000 could become 200,000. So 7%, 5 to 7% is what basically borderline is what you should produce. So I would say to people, I think I could do that. I have exceeded those numbers significantly over a long period of time. I don't want to say it here because, again, I'd be inflating people's expectations, and the best is to have managed expectations. Rather underperform or overperform, but underpromise and overdeliver. That's the basic philosophy that I have.
You talked a little bit about time. What is the right amount of time to invest your money, or you to invest my money?
Right. So the right amount of time is to have a long-term framework. By long-term framework is that you should have an expectation of 5 years. 5 years is a long, reasonable period of time. Think about it. We are so not thinking clearly how we should invest. If you start a business off from scratch, it takes at least 3 to 4 years just to even get off the surface, even to break even. To have expectations less than 5 years is to be unrealistic and to become disappointed. There again, your expectations are going to be very disappointed and they're not going to be managed. 5 years is a very decent period of time. I find though that the months, 18 months or 1.5 years is the period of time that I need to settle an account. People come to invest with me at any time of the year. They may have the money, I want to invest it now. That's fine, you can invest it now. But there is a potential that you might be buying the share price, the company, at a higher value than what it could become. So you could have a situation where you could buy something, let's say at $10, and it might drop to $7. Does it mean that because it dropped from $10 to $7 that you've lost money? No, it doesn't. You've always got to look at whatever the price of the share expressed about the company, is it potentially meant to go to $15 where you were meant to before, and now it's at $7? So shouldn't you be buying more now, not selling? My holding people's hands are to help them not to do the mistakes of what many people do. Many people, there are certain quotes or philosophies that people bring into the world with them. Oh, I bought this stock at 10, now it's at 7. I'm going to sell it when it gets back to break even. How do you even know it's going back to break even? If you don't understand the company or the business that you've invested in, you never know. All of that, when you say I'm going to wait till break even, is nonsense investing. It's investing just on hearsay. You have to look at the facts.
So your research and your experience and your wisdom gives you the tools you need to help kind of hold my hand through this process.
100%. But I would tell you as well, when you start investing with me, expect 18 months for your account to settle. If the markets are completely, I'm talking about the markets because I'm not investing in the markets, but let's say the company price is being beaten down completely, which are the kind of companies that I look for, normally you can sometimes settle immediately. If you bought them deep down enough and you know that they're not going any further because they are so discounted already, you can settle that account pretty quickly. But again, as I said, if you bought at a higher price, it goes down, not to worry. That's the time you need to add more.
So talking about going up and down, when that share price goes up or goes down, what thoughts or feelings or actions do you take?
All I'm looking at when it's up or down is what is the value of the company. I don't know that people understand what value of a company means. Could I use an example, if you don't mind? Okay, we're going to start the Sharon Ivan company. So just to make it short, we're going to call it the SI company. And in this company, you are going to put some money in and I'm going to put some money in. And we have now $10,000. You've put $5,000 and I put $5,000 in. Okay, so what do we have? We have a company with $10,000 and you have 500 shares and I have 500 shares. Okay, so we've got 1,000 shares and our company's got $10,000. Okay, so each share, okay, is $10. You agree? Mm-hmm. If we now decide we don't get on well and we're going to cash out our business, we want to get out of our business. This is after 3 months. We haven't spent a penny, may have a little bit of interest. What do we have? We've got a company with $10,000 in cash and you've got your 5,000 shares and I've got my, or you've got your 500 shares and I've got my 500 shares. Agreed? Mm-hmm. We go and cash the money out of the bank. Sharon, he has your $5,000. Ivan, he has your $5,000. You agree? Now what happens while we're going along, we're getting on very, very well, our business is going, we're still planning it out and everything else. Someone comes to you and says, Sharon, you know you have 500 shares in that SI company. Can I buy some from you? And you say, sure. And the person offers you $5 a share. What would you say?
Not a good deal.
Why?
The value is more.
How much?
$10 a share.
So you're not prepared to sell it at 5?
Nope.
But he's a friend of yours. No one ever wants to should sell anything for something that's worth less than what its value is. You've clearly said that we've got $10,000 in the bank. You can get the $10,000 out. We've determined that we've got 1,000 shares in circulation and that it's worth $10. When a person offers you $5 or $3 or $7, you're not going to sell it. What are you going to do? If it were selling for that price, you'd be buying it all day long. That is what we are doing at Kingsley Advisors. We are buying companies whose value is greater than what's expressed in the share price. We know that the value of these shares are worth a lot more than what's expressed in the share price because we know the value of the company. We know what that $10,000 is. We know we can cash it out and get that amount of money. I hope that explains it. That's what we are, what we call value investors.
Right, so that value investor, that's exactly what that means.
Right.
Getting a good value for that investment. Okay.
Exactly.
So we as investors all internally have a description of how we view ourselves. A patient investor, a fast trading investor, a 1 year type of investor, a long-term investor. So what's the best type of investor that fits with your business?
Okay, so the best kind of investor is when you have the attitude, I'm talking about attitude now, that you own the business. You don't own shares, you own the business. You actually own the $10,000 that you have in the bank. You're not owning the shares which are trading at less value. So your attitude has to be that I have become now the owner of a company. So what we are when we're owners of companies, we are not looking to dispose of it. We're not looking to trade it. We are looking to own it to get the best value out of this company that has the most incredibly discounted assets. So in terms of like, I may have mentioned, like I have people come to me and they want to invest and we say, oh, we're going to invest long term. I can tell you that people can be invested as long-term investors for a week, 2 weeks, 5 weeks, 5 months, 6 months. Their commitment is paper thin, paper thin, tissue paper thin. People have an idea that they're going to be a long-term investor, give them a few months and their emotions change. The stability of an investor comes again by us holding their hands and saying, wait a minute, we had a commitment for this for 5 years. We want to make serious money for you. We cannot make serious money for you if you are going to be changing direction. Now I understand everyone you might have a tax problem, they might need to cash in for taxes, they might have to cash in because whatever reason. That's a problem that might change, but you should not be changing your philosophy.
Well, so let's talk about diversification. What's your thoughts on that?
Okay, so diversification is the number one probably expressed idea for good investing. And I go counter to that and say that diversification in buying numerous companies, I'm not talking about you can have different categories of investing. You can invest in real estate, you can invest in art, you can invest in stamps, you can invest in land, raw land or whatever. Those are categories that you can invest and you can diversify. But for you to diversify, buying 10 to 12 different companies is an indication that you have no real commitment or understanding to the original investments that you have. If you knew that you're buying something of great value, you would buy a lot of it. Our way of making money for our clients is to buy deep into a company. We're not looking to hold 5 to 8 to 10 different companies in a portfolio. We're looking to hold 3 to 4 companies. That's it.
How many companies can we manage at once? 3 or 4 sounds like
yeah, I mean, there's a lot of work to know about a company. We're having an investor meeting next week, actually in Dallas, and we're going to be having 3 of the company managements come down and to tell their story. So people will have first-hand experience of knowing who the companies are and who the management is. At that time, questions can be asked and raised, and they themselves can become the advisor on that day.
And this handful of companies that you've hand-selected, you've researched, you've looked into them, you've got experience with them, and you've said, these are the ones we're going with. These are the companies that you're on board.
Well, 2 out of the 3, yes. One of them is a new entry. It's interesting, but not something that we are invested yet. 2 of the companies, we've got deep invested money into each of those 2 companies. The other one is in the same category, in the same area of investing, which is gold exploration, but it's not one that we committed to yet. So this is a time for us to do a little bit of our own investigative work.
You're still in the research and process.
Exactly, right.
So how would I or any investor be able to know that we're winning or losing with our portfolio? Obviously, if the money in the account is more than I originally gave you, I know I'm winning, but how do I accurately portray the win that has meaning?
Okay, so what needs to happen for you and I and all investors is to understand that there's only 2 ways that you can make money. One is live long enough, so that's time, and the other one is return. How much is this person making me money or not making me money? So if, for example, you have a person that doubles your money, and people get very, very excited about that. If a person can double your money in 20 years, okay, that's not such a great return. That means to double your money every 10 years, we decided was 7%, and then to double it again. So it would be a long period of time. If it takes too long, the returns aren't going to be good. And we know that we want to get a minimum of 7% each year. So if it's less than 7% a year, and you measure it by the annual percentage rate return since inception, everyone can have a good year. We had the Trump rally. Does that mean that people knew what they were buying? No. It meant that the boats all got lifted up with this tide. It doesn't mean that anyone was experienced or that they got there. They may have been lucky. There is an element of luck as well. Don't get me wrong. There's an element of luck, timing, finding the right company as well. But yeah.
What sector do you have a concentration of your investments in, and why'd you choose them?
Right. Well, I've had different stages of my career. Right now, I'm more prone and leaning and invested in gold exploration companies. Now, when you hear that initially, you can see a piece of raw land and a person going with a pan and a drill, or a pick, trying to find gold. That's the initial impression that we have in our mind, but that is where I'm at. Just to give you an indication, the average producing gold mine throughout the world is producing 1.03 grams of gold per ton of rock. Let me give you an idea, just to illustrate by way of picture. 1 ounce is approximately 28 grams. So the Kruger Rand, the Maple Leaf, the dollar, the American gold dollar sort of thing, all of that is 28 grams. You try and imagine 28 tons of rock for 1 ounce. So when you realize that, you say to yourself, well, I wouldn't want to be in that business. Who would want to be in a business like that? No one would. But if I can find gold, and the companies that we have found, we're only investing in them once they've found the gold. But if they can find gold at 12 to 15 grams per ton, you're looking at approximately 2 tons of rock for every ounce of gold.
That's a big difference.
That's one of the companies that we have, has got those numbers. The other company that we have is about 3 grams per ton. Still, 10 tons of rock is a lot less than 28 tons of rock. And so what we do is we find the exploration companies that have the higher grade, not the lower grade. The lower grade, remember, was 1.03 grams per ton. If you can get 3, and if you can get 12, and if you can get 15, you're well ahead of the game. And those companies, it's not a matter of if they're going to be acquired, they're going to be acquired. It's just a matter of when they're going to be acquired.
So why does gold exploration, this sector, make sense?
Well, gold exploration makes sense because that's where the upside is. You're not involved in the processing. It is for you to see that gold coin and you've got it in your hand, it has gone through an enormous amount of work. First of all, to get it out of the ground is one part. Gold, let me give you an explanation. Gold trades for about $1,300 an ounce right now. When a gold exploration company is purchased, they get paid approximately, sometimes, anywhere from $75 an ounce to maybe $125 to $150 an ounce. What is the discrepancy between $175, $125, and $1,300? Huge. Why is it so big? Because that's how costly it is to get it out of the ground and to process it. So I want to make the money right in the beginning. I don't want to go through the processing stage. The processing stage takes you bought the gold in the ground for $100, let's say. It's taking you about $1,100 or $1,000 just to process it. Who wants that kind of business? Now, if you've got a high-grade project, high grade, like 12 grams and that, you might only have a cost of producing it at $600. So I wouldn't want to get into the producing side of the business. I just want to get into the exploration, find the gold, sell the gold, bye-bye.
What makes you feel good about this sector?
I think I've been in the business long enough and in this particular sector to know it pretty well. You have to know the management and know them well, and unfortunately I've been blessed to know some very, very good management in the sector. You get known as an investor, people come to you now, and by that you get a comfort level by investing in it, and the experience level that I have in it, and that's what makes me comfortable in it. But there are other sectors that I have been in, but I think this is No one likes gold right now. They might like gold because it's trading at 1,300, but the gold stocks are the most hated area to be invested in right now. And the more hated it is, the more I love it.
How much of my wealth should I be investing with you?
That's a very personal decision for each individual person. But again, as I said, some people have they are prone to want to like real estate. Some people like business. Some people like art. So people have those categories that you have to develop. If you have a great interest in one area, you'll probably have more of that going towards that. But in terms of how much each individual puts in, I don't know. But all I know, whatever money I do get, it will be invested in concentrated positions. You won't be invested in more than 2 or 3 companies at a time.
I want to go back to something you said before. You mentioned penny stocks, and you talked about changing to, changing companies. Can you tell me a little bit more about penny stocks? Can you explain that better to me?
Yeah. A simple way of it is that if you have a pizza, you have a round pizza. You and I started off our company, didn't we? We started off our company, we put in $5,000 each. You had 500 shares and I had 500 shares. So the pizza for our company, we've got 1,000 shares, 1,000 slices, okay? Now we decide, you want to know something? Why don't we make our pizza, we'll keep it the same size, but we're going to cut it up into different pieces. Instead of being worth $10 a share, let's make it to $1. So suddenly our 1,000 shares now becomes 10,000 shares. So now our share price is not $10, it's now $1. It becomes a lot more attractive for other people to come and invest, where they can buy, like, let's say 1,000 shares at $1 rather than 1,000 shares at 10. So it's an appeal that like brings the entry level for people to come into your company at a lower bar of entry, and it feeds on the greed factor of people, because if they know that they own 10,000 shares, even if it's worth a penny, they feel like they're wealthy. There's been a lot of mischief in the area where people would form corporations and make low price share prices, and people would be lured into that. So there is a propensity for people to be setting up low price shares for malpractice, to do bad things. But because that does happen, doesn't mean that it happens all the time. And for that simple reason that if everyone hates gold and everybody hates penny stocks, I'm able to buy my companies at a much greater discount than anybody else when they buy in their regular companies that are trading at $100, $20 or whatever, because they think it's all secure. That doesn't mean it's all secure. I know my business. The fact that the pizza is cut in so many slices, I don't worry about that. I'll buy as many slices as I want of a company that's of good value.
Thank you for breaking that down for me. I really appreciate it.
Sure.
Yeah. So what else should I ask you, Ivan? What did we forget?
What did we forget is we're there to make money, but money is made in the waiting. What do I mean by that? Money is not made quickly. Quick money gets lost quickly. And I think the idea that if people can become patient and they can trust and verify is also good. Sit down with a person once a quarter, once a year, and see that the confidence level that they have in the investments is meritorious. I think many people can sell a good bill of goods, and I hope that I do sell people on the merits of what really is there. The other thing is I love losses, and I think that's an important thing. I'm not scared to take a loss. If you have made a mistake in your investing, don't live on hope that it's going to go back to break even. Get out of it. If you've made a mistake, you get out of your mistakes, take your loss, and retain the money that you have and invest it properly the next time.
Ivan Sachs, thank you for taking this time
With
today.
pleasure.
Kingsley Advisors. And what's the best way for someone who has more questions to get in touch with you?
We do have a website called kingsleyadvisors.com, which has our contact information over there. And basically we would sit down, we'd find out if there's merit to us working together, and we'd go from there.